China's economy is crashing. I'm your host, Steve Van Metre, and thanks for joining me today. For China, the hits keep on coming as its slowdown is now rippling across the world. Let's over to Bloomberg, where we picked today's story up with the headline, that China's economy takes hit from global slowdown as exports weaken, and exports to the U.S. contract in August for the first time since 2020, spelling bad news for commodity producers. China's export growth slowed more than expected in August, and imports stagnated, a sign of a darkening global economic picture and weak domestic growth hit by COVID lockdowns and a property slump. Exports in U.S. dollar terms expanded 7.1% last month from a year earlier, the slowest pace since April when a lockdown in Shanghai disrupted shipping and far weaker than economists had predicted. Imports grew just 0.3%, leaving a trade surplus of $79.4 billion last month. And you can see that even though export growth is slowing, it remains well above pre-pandemic levels. But what is this issue we're seeing here? It's an issue of the dollar, because what should happen is when the dollar is strong relative to other currencies, it should mean there's a lot of imports to the U.S., a lot of exports from other countries, because what it does is incentivizes American consumers and businesses to buy foreign produced goods and services. That's what a strong dollar does. So if we're seeing a slowdown amid a strong dollar, it tells us that there's something wrong. Let's take a look at this chart here, where we've got the nominal broad U.S. dollar index in blue and against the imports to the U.S. of goods and services in red on a year-over-year rate of change. And normally what you want to see is during periods of a rising dollar, you want to see imports start to come back and be fairly strong. You notice there's a couple points here where they slightly contracted, but they moved and continued to trend back up here. It's periods here where we see the dollar shoot straight higher and imports come crashing down. And we see that again here during the pandemic. Dollar shoots up, imports come crashing down, that it tells us that there's a bigger issue going on here. Is it that the dollar's strong just because there's a demand for dollars, or is it strong because there's a shortage of dollars? Two different issues here. If you're seeing the dollar surge higher because of a shortage, it means the global economy is going to slow down and even contract, and that is the risk that China's facing here. Is the dollar is strong because there's a shortage, and that's why we're seeing the global economy cool off. Let's continue on, because China's slowdown is rippling across the world, with weak import figures spelling bad news for major commodity producers such as Australia and Brazil. Top manufactured good makers like Germany and South Korea are also seeing weaker demand from China. So why is this an issue? Why would imports to China be a problem? Well, think about this. If you're the major exporting nation of the world, what are you doing? You're exporting goods that are done, or mostly done, parts that are completed that need to go to other places, maybe for final assembly. So what do you need? Raw materials, right? So if you're building widgets and exporting them, you need all the raw materials to make that widget, to put it together and move it out of your country. So when we see imports to China fall from commodity producers, it tells us again, the global economy is slowing, and that's what we're seeing around the world. Big problems. At the same time, global demand for Chinese goods is waning, no surprise, as U.S. consumers cut back on spending because of soaring inflation and shift away from pandemic-related goods towards services. But even then, we're seeing signs that the services sector is contracting. So what does it really mean? Well, we'll look at that in a second, as factories in Europe and the rest of Asia are also scaling back production. And simply what it means is that U.S. consumers don't have as much money. It's not necessarily a story of inflation, it's a story of lack of wage growth. And here we can see the average hourly earnings of employees subtracting off the consumer price index. And we know up until recently that overall post-pandemic that wages have been falling relative to inflation. So it's not a story of just, hey, prices are rising. The issue is wages aren't rising to keep up with them. The global economy is slowing down, particularly with the troubles of what's happening in Europe. So double-digit export growth in the past is not sustainable. Going forward, single-digit export growth is more likely, suggesting the global economy is going to continue to slow. As China's exports to the U.S. fell 3.8% in August from a year earlier, the first contraction since May of 2020. Exports to the European Union held up a little bit better, recording 11.1% growth, as China is supplying more energy-intensive goods like aluminum, which have become more costly to produce in Europe. Even so, the increase was still less than half the pace recorded in the previous month. So again, we see this in exports to the U.S. coming down, telling us this is becoming a demand issue for U.S. consumers just can't afford to spend at the rate they used to. They don't have that fiscal and monetary stimulus to back them up, and we're seeing, again, the global economy slow. A smaller trade surplus going forward will weigh on the currency, speaking of the yuan, which we'll talk about a little bit more later in the show, which has slumped this year and is close to breaching 7 to the dollar. The People's Bank of China has taken several steps recently to slow the yuan's depreciation and set its reference rate for the currency at the strongest bias on record on Wednesday. And one thing that shouldn't depreciate with the global economy, that's your portfolio. I'll put a link up here to Portfolio Shield and in the description below. Let's continue on because China's home prices are slumping, and that means all things are not looking good there again, as declines deepen in August despite a measure to revive demand. Again, in the face of a slowing global economy, real estate prices are going to fall. As new home prices in 70 cities, excluding state-subsidized housing, dropped 0.29% last month from July, when they fell 0.11%. From a year earlier, prices dropped 2.1%, the most in 7 years. As China's 2.4 trillion new home market is showing little signs of recovery, adding to the drag on growth in the world's second largest economy. Other figures released Friday show residential sales tumbled about 30% in the first 8 months of the year, and property investment shrank more than 7%. Again, this is all just signs of a slowing global economy, because when economies are booming, people want to buy things and they want to invest and they want to have a bigger home and they buy real estate. And when things slow, well, naturally what happens? Sales start to slump, and then eventually, if they don't pick up, prices come crumbling down. And when looking at the secondary market, it also saw deterioration as prices of existing homes fell 0.35% in August, faster than the previous month's 0.21% drop. The declines are weighing on sentiment, along with a mortgage boycott by home buyers who are waiting for cash-strapped developers when they may wait a long time to complete delayed projects, as rising unemployment and China's strict COVID restrictions are also denting the economic activity. And now that means is China is going to keep stimulating. Here we see with this headline is China announces 200 billion yuan loan support for investment. But the question is it going to work? And the answer is no. And the reason we know is because when there's a dollar shortage, providing stimulus in yuan, or well, any other currency for that matter, isn't going to solve the problem. The funds will be used to support banks to make loans to firms who upgrade equipment in the fourth quarter, the State Council announced after a meeting on Tuesday. Banks were encouraged, get this, to lend companies in manufacturing and services sector, as well as small firms at interest rates not higher than 3.2%. In addition to relending, smaller companies will also be able to defer tax payments for another 4 months from this month, providing 440 billion yuan worth of tax breaks. And so here's the issue. Do you think these manufacturers actually need, more equipment and things like that? No, because in a slowing economy, you don't. In fact, if anything, if you're going to spend money on that, what are you going to use it for? That's right. You got it, to displace workers and further automate. And then something China is going to have another big problem with, as we'll get to in this show in a little bit. And so what do they do next? Well, of course, China holds a key rate. And note this, withdraws liquidity amid yuan defense as, of course, the dollar continues to soar against all other major currencies. As China's central bank drained liquidity from the banking system for a second straight month while leaving rates unchanged as it sought to ease pressure on the yuan from a widening policy divergence. The People's Bank of China offered 400 billion or 58 billion in US dollars via its medium-term lending facility, matching the median forecast in a Bloomberg survey. This would result in a net withdrawal of 200 billion yuan in September. So again, you're seeing cases here. They're trying to stimulate their economy. At the same time, they're trying to keep their currency from blowing up, but it's not working. And where does the buck stop? As yuan tumbles below $7 per dollar, as Bloomberg's Christine Aquio, the dollar may be about to meet its match in the form of Asia's biggest economies. Early this morning, East Coast time, when China was sleeping, the offshore yuan just weakened past $7 per dollar for the first time in more than 2 years, reflecting China's broad economic weakness and lockdown lows. And see, that's the story that you hear from the media is, oh, well, people don't want yuan because their currency is slowing down, or the demand for their economy. Look, that's not what it is. It's not that people don't want yuan. That's not the issue. I mean, broadly speaking, most people don't, but it's not the function of China's economy is slowing. It's because they need dollars. And so rather given the choice is, hey, would you rather have yuan or dollars? Well, they need dollars, and so they're going after that. That's the issue here. Again, the story is, hey, China's economy is slowing, so why do people need yuan? Well, they would need it if the global economy was growing and if the dollar wasn't as strong. And China braces for a slowdown that could be even worse than 2020, as their GDP is set to expand at 3.5% this year, which is very low for China. It's not just China's strict COVID-0 policy of lockdowns and mass testing that's buffeting the economy. A housing market collapse, drought, and a weak demand at both home and overseas have all undercut growth, notably something that monetary policy can't fix. And China's economy shows signs of recovery as stimulus ramps up, but notably industrial output and retail sales have expanded faster than the outlook. But keep in mind, this is again very transitory. What did we learn from FedEx in yesterday's show? That there is a broad slump in shipping, and that tells us that whatever these little pockets of excitement that you're going to see in the data, they're going to be transitory, because China's last big problem, well, it's coming and coming soon. And here you can see that China's youth jobless rate remains stubbornly high, despite a slight improvement in August, as our jobless rate for 16 to 24-year-olds was 18.7% in August, down only slightly from a record high of 19.9% in July. And with that, some 10.76 million Chinese students will graduate this year amid a slowing economic growth, putting even more pressure on this country's job market. So we can see what's going on in China is just a reflection of what's actually starting to happen around the rest of the world. It just happens that in the biggest exporting nation, we see it first. And again, as we talked about in yesterday's show with FedEx's signal that, hey, shipping is slumping, it's just a sign of what we know is coming. The global economy, leading by China, is heading down. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.